And so now I think we've just started the next bull market, the next leg up, which I think will be at least proportionate to the first leg, which was, the 250 to 1900. But that's a huge increase in the price of gold. You're talking about 6, 7 times increase from here. And, we're at 2,600 or from 2,000, let's say. So a six-fold increase from 2,000 is 12,000. 7 is 14,000. So kind of at a minimum, we're going up there. But I think the potential is much higher because we're just going to print so much money. We're going to have so much inflation that the dollar is going to lose so much value that you're really going to need a lot of dollars to buy gold. And, if gold can go from $20 an ounce to $2,600 an ounce, it can go from 2,600 to 26,000.
Leading market analysts are forecasting a potentially historic bull run in the gold market, with projections suggesting prices could reach unprecedented levels. PeterSchiff is an economist and financial commentator known for predicting the 2008 financial crisis. According to Schiff, gold has begun the next leg of its bull market, which he expects to be at least as proportionate to the previous rise from $250 to $1,900. He predicts a 6 to 7-fold increase from the current price of around $2,000, bringing gold to $12,000 or $14,000 per ounce. Adding weight to these bullish projections, analyst Rozencwajg suggests that gold could be increasingly important in balancing international trade surpluses and deficits. Current trends appear to validate this perspective, as central banks continue to expand their gold reserves, indicating growing institutional confidence in the precious metal as a strategic asset. Schiff emphasizes the long-term historical trends in the gold market, particularly the bear market from 1981 to 2001, where gold dropped from $850 to $250. He notes that this was followed by a bull market that saw gold rise to $1,900 by 2011. Historical data from Bloomberg provides additional context for understanding these market patterns. During the previous bear market, gold's performance typically showed modest gains, averaging 1.3% in the second half of each year, while experiencing losses averaging 3.9% in the first half. However, the current market presents a more nuanced picture. Gold prices remain below the critical resistance level of $2,670, with trading activity showing limited directional momentum. Before diving deep into this video, subscribe to our channel, hit the bell icon for notifications, and share this with anyone who might benefit from the insights we're about to explore.
If you kind of measure the move, so gold was in a bear market from 1980-81 until 2001. So it had a 20-year bear market where it went from 850 down to 250 approximately. Then it had another bull market where it went from 250 up to 1900. And that bull market peaked in 2011, and it really lasted just 10 years. So that was the initial breakout from the bear market. Then we pulled back and we had a consolidation where we went from 1900 down to about 1,000 in 2015, then back up to 2,000 in 2020. But, we pretty much stayed between 1,700 and 1,900 for a few years. We didn't really break considerably above 2,000, get to 2,100 until this year. And so now I think we've just started the next bull market, the next leg up, which I think will be at least proportionate to the first leg, which was, the 250 to 1900. But that's a huge increase in the price of gold. You're talking about 6, 7 times increase from here. And, we're at 2,600 or from 2,000, let's say. So a six-fold increase from 2,000 is 12,000. 7 is 14,000. So kind of at a minimum, we're going up there. But I think the potential is much higher because we're just going to print so much money. We're going to have so much inflation that the dollar is going to lose so much value that you're really going to need a lot of dollars to buy gold. And, if gold can go from $20 an ounce to $2,600 an ounce, it can go from 2,600 to 26,000 or to 100,000, right? I mean, there's no limit because, again, gold's not changing. All we're doing is decreasing the value of the dollar. And they could print them, they could drop trillions of dollars out of helicopters, right? What stops them? Well, I mean, you can't like gold and not like silver, really. I mean, in fact, silver at $31, $32 an ounce is an incredible bargain. I mean, historically, you can buy a lot more silver with an ounce of gold than you typically can. So silver is very cheap. In fact, even in dollars, silver was $50 in 1980. There's not that many commodities that you could buy today for, a substantial discount to what it cost in 1980. So I think silver is a good deal, and the price is going to go a lot higher. People should buy both gold and silver. And, that's what we've been recommending at Schiff Gold. In fact, people, should, as soon as this interview is over, go to the website and buy yourself some silver before the sale ends. I mean, I think we're going to blow through $50 pretty quickly, probably by next year. And then we're not going to look back. I mean, it's going to be a long way down when people look back at $50 silver. So this is a chance to get it pretty cheap. But again, it's not so much silver going up or the gold going up. It's the dollar going down. It's the euro, it's the yen, it's the pound. All of these currencies are going to lose purchasing power. So you're going to need more and more units of pretty much every fiat currency to buy the same quantity of gold or silver.
Schiff points out that traditionally, gold mining stocks tend to lead gold prices, with mining companies' shares anticipating higher values and reflecting these expectations through enhanced price movements and P/E multiples. However, the current market has deviated significantly from this historical pattern. The past 18 months have proven particularly challenging for gold mining companies, which have struggled to keep pace with bullion's impressive performance. This underperformance is especially noteworthy given the broader market context, where stocks across various sectors have generally enjoyed substantial gains despite occasional setbacks, such as the recent Tuesday sell-off and the market decline in early August. This disconnect between gold mining stocks and physical gold prices presents an intriguing scenario for investors and market analysts. While gold continues to demonstrate its strength as a safe haven asset, reaching near all-time highs, the companies involved in its extraction have yet to reflect this robust performance in their stock valuations, creating a notable anomaly in the precious metals sector. In light of this situation, Schiff also anticipates that gold stocks will post significant earnings beats in the third quarter, especially in Q4. As a result, major gold companies are likely to announce dividend increases and share buybacks. Let's get back to the video.
In a bull market, you would expect the gold stocks to lead the metal, that they would anticipate higher gold prices, and so they would incorporate that into the price, into the PE multiples. But what's been interesting or unique about this bull market is that the gold mining stocks have lagged, and they constantly have to catch up. Gold will go up and make a new high, and the gold stocks will eventually go up. Gold will have a small correction. Maybe gold drops 50, 100 bucks. Gold stocks will get killed by 10%, maybe 20%. Then gold will make a new high, and gold stocks will start to come back up, and then it keeps making new high, new high, new high, and then eventually the gold stocks make a new high, and then gold has a correction, and the gold stocks get killed again. And so they're really having a hard time outperforming gold like you would expect them to do. And I think that's because nobody believes this bull market. They've been bearish the whole way. It's been climbing the mother of all walls of worry. I think that is going to change. I mean, you look at the big gold stocks like the Barrick and the Newmonts, they're trading at discounts, sharp discounts to the S&P 500. They historically traded premiums. And so they're cheap. The gold companies are priced to book. They're historically low. So there's a lot of bargain here. And I think that we're going to start to see the gold stocks coming in with some big earnings beats. Third quarter, I think this quarter, and especially Q4, which will get those numbers in next year. But I think we're going to see big beats. These major companies are going to be announcing increases in dividends. They're going to increase share buybacks. Then you're going to start to see some consolidation, more acquisitions. The market is eventually going to really go up. And, one of the problems that the gold stocks have had is that they've been an ironic victim of inflation. And it's ironic because you would think that they would benefit from inflation. But inflation drove up the cost of mining, but the price of gold didn't go up commensurate with that. Even though it's gone up a lot, mining costs have gone up even more. And I think that that's changing. I think you're going to see gold going up a lot more than the cost of mining it. In fact, if you look at oil today, oil's at an all-time record low priced in gold. You can get almost 40 barrels of oil for an ounce of gold. That's great for gold mining companies. And the wages now are not, running because they're not, the US dollar has not been that weak. Normally you have a weak dollar relative to other currencies in a gold bull market, but we've had gold moving up with a dollar, stable to firmer. Although it's been weakening recently, it hasn't really gotten killed. The DXY is still above 100, and so you wouldn't have thought that we'd have $2,600 gold with a dollar index still above 100. But we do. But that's great for the gold mining companies because their wages are not in dollars. And so, I think they're going to really start to make up for, the lost ground. And Wall Street is completely off guard. Nobody really is following this sector. In fact, earlier this year, back in February, March, several of the brokerage firms downgraded Newmont, downgraded Barrick to basically sells when gold was just about 2,000. And those stocks hit multi-year lows. Earlier this year, you had multi-year lows in the largest gold mining companies. I mean, I took advantage of that. I was buying more myself, even though I already owned a lot. I couldn't, help it. I had to buy more because I wasn't going to let that gift just go away. And I was pounding the table on my podcast back then, telling people, you got to buy these stocks when Wall Street is giving them away because they're basically capitulating. And I remember when they downgraded, was it Barrick, the analyst said, I'm downgrading it because I don't see any upside potential in gold. Gold's at 2,000, it's fully priced, it's not going to go up, so why buy a gold stock when gold can't go up? And of course, then gold had its best year, probably since that guy's been alive.
Gold remains a vital safe haven asset, reaching near all-time highs. However, gold mining companies have struggled to match this performance, deviating from the usual trend where mining stocks typically lead. This underperformance is notable, especially in a broader stock market that has generally experienced gains. Despite this lag, significant earnings beats for gold stocks are anticipated in the coming quarters, along with potential dividend increases and share buybacks. What are your thoughts on the current trends in gold and gold mining stocks? Let us know in the comments below. If you found this article helpful, please subscribe, and share it with others who might benefit from it. Thank you for watching.